Why is it that almost every investment banking analyst wants to exit to private equity? While the work is arguably a lot more interesting, the decision often also comes down to one word: money. I mean, we are talking about finance bros after all. We're not talking about teachers or firefighters or nonprofit workers. And so in today's video, I'm going to be going over how PE comp works, broadly speaking, and then go over comp for every position from the analyst to partner level. So get ready for some juicy numbers. Now, before getting started, if you're watching this video because you're interested in breaking into private equity, you may want to check out the PE Investing Certificate program being offered by Wall Street Prep and Wharton. This program is sponsored by top firms like Blackstone, Carlyle, and KKR, and over 8 weeks, you can learn at your own pace through this online course that's taught by Wharton professors, Wall Street Prep's PE program director, and real PE investors, including David Rubenstein, the founder of Carlyle, and Martin Brand, the head of North America PE at Blackstone, who will cover topics like the PE deal process, how to think like a private equity professional, and more. By completing the program, you also unlock access to the alumni member database, fireside chats with PE investors, and exclusive networking events with the world's top private equity headhunters. This program runs 3 times a year, and be sure to use my code rareliquid to get up to $500 off, and I'll leave information for everything discussed in this video's description. All right, now with that said, let's go first into how PE comp works at a high level. Similar to banking, PE comp at the junior level for analysts, associates, and senior associates is primarily composed of a base salary and an end-of-the-year bonus based on both your individual and your firm/fund's performance. But as you become more senior at the VP level and above, you have opportunities to co-invest alongside your own fund and earn additional compensation in the form of carried interest. Now, for some context, regardless of size and strategy, PE funds generally follow a fee structure made up of management fees and carried interest. You may have heard of the 2 and 20 structure, where PE funds charge a small percentage of total funds under management, typically around 2%, to cover daily operating expenses like rent and salaries. And then when a fund sells its portfolio companies, aka its investments, the PE firm pockets 20% of profits as carried interest. So for example, if a $100 million fund grows to 200 by the end of year 1, roughly speaking, the PE fund gets paid $2 million in management fees and $20 million in performance fees. And given that PE firms are pretty small and can consist of, let's say, 10 investors, this could mean $10 million for the founding partner, $1 to $3 million bonuses for MDs and partners, and $250,000 to $750,000 bonuses for principals and VPs. And this is what makes carried interest the most lucrative part of private equity pay and makes PE harder and harder to leave as time goes on because your pay just grows exponentially. All right, now next up, let's go into how much you can make at each level in private equity. Now, interestingly, since my last video on PE comp a few years ago, compensation has increased at the junior level, but slightly fallen at the VP and director level. And I'll be referencing the 2024 report from Heidrick & Struggles, as well as crowdsourced data from my contacts across the industry for the numbers that you're about to see. First, starting at the bottom of the totem pole, PE analysts are usually paid in line with investment bankers at the same level and are paid between $110K to $120K in base salary and a bonus ranging from $65K to $125K, resulting in total comp of around $175,000 to $250,000. Something I didn't really discuss in my last video is that one major recent shift in the PE recruiting landscape is that firms are increasingly starting to hire at the analyst level, and so it's increasingly common to see college students complete summer internships at some of the most prestigious PE firms and then join the firm directly upon graduating. And so even though PE analysts are not paid more than bankers, the primary advantage here is that this pathway allows recent grads with strong interest in investing jump directly to the buy side instead of having to go through the 2-year investment banking program first. With that said, of course, the vast majority of people do join private equity firms as associates after banking, and at this level, your comp typically ranges from $250,000 to $400,000. At the associate level, it's very rare to earn any carry, so this total compensation number is usually composed of $150,000 as the typical minimum base salary for your first-year associate in megafund PE firms like Blackstone, Apollo, and KKR, with some variance amongst different megafunds depending on geography and specialty. For example, notoriously more selective and brutal funds like Apollo, Warburg, and Apex sometimes pay higher base salaries between $175K to $200K for junior associates. On top of the base salary, funds pay associates performance bonuses often equal in size or larger than base, which brings the total comp up to that $400,000 number at certain funds. One interesting thing to note is that in recent years, funds that were traditionally regarded as middle market and therefore not as well known as mega funds have really scaled in fund size, performance, and overall industry prestige. Some of these funds today now rival or sometimes pay higher than legacy mega fund PE shops. For example, CD&R, a pure play buyout shop which raised its largest fund ever in 2022 at a staggering $26 billion, pays a base salary of $175K for first-year associates with even higher bonuses than a lot of mega fund PE firms. Moving on to the next level, after 3 years, associates are promoted to vice president, where you earn between $300,000 to $685,000 just from your base and bonus. And so you can see here that the range really can widen at the VP level depending on your firm, and even more so with your fund's performance, since carry becomes an increasingly larger portion of your compensation. After another roughly 3 years, you become a principal, where your base plus bonus now ranges between $558,000 to $970,000, and pretty much everyone at this level and above gets carry, which adds even more to your compensation. Next, we have managing directors, partners, and managing partners. And this is where things can get really varied and go as little as $640,000 to upwards of $2 million. And in certain cases, beyond $20 million if you're at the right firm and if your fund has an amazing year. And of course, if you're a founding partner, you can make upwards of hundreds of millions of dollars in a single year. Alright, so that concludes the video, and let me know down in the comments if you expected lower or higher numbers. In the next screen, you're going to see a video about a brutal week in the life of a private equity investor. That said, thank you guys as always so much for watching this video. Hope to catch you all in the next one.